Hi there. Wish you all a very good morning, afternoon, evening, depending on the time zone that you are watching my videos from. Uh, so here today on this weekend, we are bringing another video to you, and this time in English language. And the basic reason for that was most of my viewers who live outside of my country were complaining lately that because of the auto-generated subtitles, they weren't able uh, understanding exactly the message behind my videos. So most of them asked me to make a video in English. So here today we are going to make this video in English. Besides my native language, uh, for all the viewers who are living outside my country. Uh, Hope you like the video today because the topic is very important. I have been getting so many messages from people and asking me to make a video on this specific this topic, that why we lose money in the stock market. So today we are going to bring this video uh, under the title of why we lose money in the stock market. My request uh, to you all is to watch this video completely because only then you can be able to understand what I'm trying to say. Uh, I definitely have a different approach of things. I look at things from different perspectives, and my way of explanation might not be the one that you normally see on YouTube and other social media platforms. So that's one of the reasons that I've been telling people, that you need to watch my content completely to understand. So let's begin with today's video. Hope you like it. Please do forward us your comments and suggestions and feedback so that we can make better future content for you. We will start this video by asking you two questions. Although you will find it straight in the beginning that why are we asking these questions? So the first question is, you were coming to the stock market to do business here, was it with a long time perspective in your mind, or was it for the short term gains? Uh, Definitely, I also understand most of you have the answer for this one. And the second question is, how many times has the stock market crashed in the last 25 years or in the recent history in your respective country? So probably not all of you might have answers for those. So, but there's an easy way, you can just Google it out and you can find out. So now many of you, I'm sure that going to ask this question, that what is the reason that we have put this question right in the beginning of this video, and how does these questions relate to the title of this video? So let me assure you, by the time you reach to the end of this video, you will find that your perspective about both these questions and the main title of this video would be very clear. And I can promise you one thing, that it will be quite different from what you are thinking right now. So let's go to the main topic, and let's leave these questions for a while. So the main question was why we fail. Uh, I'm quite sure that most of you already know the answers. Uh, and I'm very hopeful that it would be the following two reasons. The first reason would be that most of you have limited resources at your disposal. You don't have that much money or endless amount of money at your disposal that you can just keep on putting it in the stock exchange. So that is one of the reasons that probably you think you have failed or you are failing in the stock market so far. And secondly, the second reason, which is almost connected to the first one, is the holding power. That because of the limited amount of money, you cannot hold on to this stocks for much longer period, if especially they are going down, or even if they are moving in the uptrend and they are getting you profit, but you can't wait or you can't risk to wait for much longer because you're afraid that they might go the other way. They might start coming down in the downtrend, and you might lose a big portion of your profits. So most of us initially, especially the newcomers who are new into this field in the stock markets, would give you definitely these two reasons for they are not making good at the stock exchange. uh, I agree and I don't agree with it, because I agree that based on my personal experience, when I started with the stock market, this was the exact same thing that I was thinking about. That because I have limited resources and uh, because of limited resources, I had no holding power at my disposal. But let me share something with you. I had this feeling when, let's say, I had 100,000 at my account while I was trading initially. So when it went to 1 million, I was complaining about the same two things. And when it went to 10 millions limit, at that point, I was also complaining about these two. So my own theory is that no much matter how much money you have, you're still going to complain because still you're going to find out that the money is too less for any successful trader to work successfully in the stock market. So these two reasons, they are not there so uh, permanently. If you think it from a different perspective, if you think it or if you take it from a different angle, you are always going to have these problems no matter how much money you have at your disposal at the stock exchange. So I don't buy this thing. I would rather move ahead and see the problem from a different angle. So moving ahead and seeing exactly what are the basic reasons that we are not performing very well at the stock market initially. So the first thing, you have to understand uh, the entire network of the stock trading, the stock market, and its affiliations with different organizations and institutions and people, how they work, and how this entire system is right now operating in the world. So it all starts with big institutions, big organizations, for example, investment banks, hedge funds. You know all what I'm talking about. So we are talking about the big organizations that have money. So they need to put their money in the stock exchanges. And for that, the stock exchanges needs retail brokers, the chain of retail brokers. And the retail brokers, in return, invest heavily on the influencers and the educators, the people who deal with social media, internet, different platforms. The retail brokers invest very heavily to this group of people because they are the ones that are finding people like you and me, the retail traders. And it is because the bombardment of information that these guys are inflicting upon us, trying to lure us in, trying to motivate us to take that big step of coming inside the stock market, the world of trading, and start investing upon the advices that they are providing us. So this is a chain. It is a continuous chain because it is working in a circular way. So you see how the things move initially, and in return, retail investors come through the influencers and educators, go to the brokers, invest their money and start trading at the stock exchanges, and ultimately that money ends up with the big organization, the corporations, the investment banks, institutions, the people right at the top. So this is how this entire cycle works. Now, on the face of it, it looks like a very simple diagram or theory, which is working very plainly without any, hitches or without any wrongdoings that is visible. But if you look at closer, you will find most of the time the institutions, the organizations that are right on the top, they are also directly related outside this system with the chain of brokers that they have. You would find many big brokerage houses working directly in relation with the interest of the investment banks, institutions, and the organizations. So, if you look closely at this diagram, this is in the terminologies of trading and the stock market. It is known as the trading ecosystem. So for the people who might have in their high schools or in their earlier period of education who have been, uh, you know, connected with science subjects, they are very familiar with this concept of ecosystem. So if you take it in that perspective, where we see that in the normal ecosystem in this world, some things have to go and they suffer because some things in that very particular ecosystem have to nourish and cherish and grow. So it is the same principle that works in the stock market as a whole around the world. Nothing has changed. It's the same where people are working for interests, and they are just pushing the buck forward, and ultimately at the losing end and at the suffering end, it is the retail trader that loses the money and that goes through that cycle of pain, which comes after losing the money. Thing starts. So if we come and sort of watch it in a scientific manner, uh, by going through the entire process, so there are top three reasons that most of the traders, the uh, small people who are coming up with their life savings into the stock market, and they suffer and they lose money. So basically there are top three reasons, which starts from its lack of research and due diligence. Second is emotional investment. And third is overconfidence. Now, it looks very simple and innocent, all these three terms that I've just showed you. If we further dig deep into exactly each one of them and to see exactly what each of them means and what it stands for. So, probably only then can we understand exactly what are the things that are required from us and what are the things that we are doing wrong. So, if we start from lack of research and due diligence, so basically, what does it mean? We are all familiar with whenever we take a big decision in our lives, we do the research, even if it is going to or selecting a good school to start our education. So our parents do the research and they choose a good place for us to go. As we grow up, then we start making our own choices and deciding for our own selves exactly what we want to do in life and how we want to move ahead. And even that thing is very much there. If you are thinking of opening up a business, a restaurant, or a store, or any gas station, you can just find so many thousand examples on this thing. So the first thing that we do is to go for research. We select the best place where we think the value for our time is equally given back to us. uh, for instance, if we are trying to open a restaurant, so definitely the first thing that we would be looking for is the right place for that. uh, the right building, right area, right sort of a neighborhood where there isn't that much problem for vehicles to park and people can access that easily. So these are a whole lot of options that we dig into, we try to find out, we research, and then we come up and sort of find and identify one single place, and from where we start our business. So exactly the same thing applies for all the people who are coming to the stock market. So most of us, if I ask you that did you do the research before joining the stock market, so I'm quite sure that most of you are going to tell me the same thing. Yes, of course, we did the research. So that is where the problem starts from, because where would you get the information and knowledge about coming to the stock market? So 99% of you are definitely going to say that it's online. Internet is the primary source of information these days. Only 1% of the lucky people who have access to books and libraries and written material at their disposal would be opting for that 1%. I call them lucky because this is the habit that has been dying very fastly in our societies. We are more and more sort of, inclined and sort of dependent on the information on internet, and rightfully so because it's so fast and it is so easily accessible. So but at some point, this 1% of the people who have the means of accessing, written material, books and libraries, uh, they also after some time fall back to the online search for the information and knowledge. So ultimately it becomes 100% of people going and falling back to the internet and online services for getting the required information. So the next question is, how do we get that information from internet? So the first thing that comes into our minds is through the search engines. You Google it, you Bing it, you there are so many. You go to Yahoo and do the search. So, and this is the way that things are done online. But then we also have to understand and realize that the search engines work as per the search engine optimization algorithms and the processes. That's why the search engines have become very popular because uh, the sites who perform well, they are projected in the upward direction. And the moment you write that I want to start trading in the stock exchange, you will get this one page having 15 different links to different sites. This is why how the system has evolved over the time. So let's say I tell you right now, just Google it, that I want to open or I want to have a trading uh, sort of as a profession in the stock market. You just Google it, you will press the enter key, and there will be 15 different links in front of you. Now, I can guarantee one thing. Out of those 15, probably 12 are from the brokers. These are their online sites that they have managed over the period of time to optimize its search engine performance, and that's why they are being displayed at the first page of Google search. And the remaining two to three links that would appear on that first page of Google search results would be the influencers, the sort of educators that are already indirectly or directly linked to these uh, broker houses or brokerage firms. So now the problem starts for you. On one hand, you are just doing innocent search, but on the other side, you are just falling right into the lap of the people who have been in search, who are in search of people like you and me to come to them for investing and to start doing business at the stock exchanges. So that's where the problem starts from. So now, once you have realized that these broker houses, these paid sites, these paid contents who have managed over the period of time to come up and come up to the top of the search engine optimization levels, they are the first one who get the first opportunity, or in other words, in quotes, the first bite. They have the right because of their placement at the Google search page. So you if realize this thing, so what is the next option available for you? So you will definitely then come up with the alternative that instead of googling it, you are going to go for the social media side. So which are the best social media platforms available to you right now? It's YouTube, Facebook, Twitter, Instagram, TikTok, you name it. Already know these, what I'm referring to. But believe me, through my personal experience, I have realized that majority of these social media uh, outlets, the channels, the people who are uploading their contents on a daily basis, and there are millions and millions of those. Uh, Most of them are fake. They give you the fake information. They mislead you. They totally put you on the wrong track, and they do it willfully and knowingly that they are committing a wrong thing. But this is a very big business right now. It's a big, big enterprise right now. So this is how the marketing is being done. So, like me, after some time, you might realize that the people, either they are lying to you, which most of them are, or even some of them who are not lying to you, they probably don't know what they're saying. They have no knowledge, no information. It is just by watching other channels, the watching other platforms, they have come upon a few terms and terminologies and few words, and they are repeating those again and again, watching to other news channels and different channels on the YouTube, and they are generating the same content with a little bit twist. It is just like, a good chef who can make different cuisine by looking at the YouTube, but just adding up or subtracting a little bit of spices and coloring it and finishing it just to bring a new sort of a dish. But although it's a very old dish, you might have eaten it so many times. So this is how the things are done on the social media. So it is a problem. Now, what to do with it? So we will be discussing it in the later part of this video as to how to cope up with this problem. So now, coming to the second point, emotional investment. So what do we mean by emotional investment? So if you sort of, read what is appearing on your screen, you can just pause your sort of video and you can read the thing. So emotional investment or investing is when investors make decisions based on their emotions, such as fear, greed, excitement, rather than on rational analysis and sound financial principles. Key characteristics of emotional investing include impulsive decisions, overreaction, fear of missing out, loss aversion, etc., etc., etc. Now, what does this all mean? Uh, in simple words, when you are in the stock market and you're looking at that stock market board, and there is this one share, one stock that your eyes get fixed on it, and you might have heard something on the late night news yesterday, and you see that the prices are increasing, and all of a sudden you have this instinct in you that you should not be left out. You should be the one who should be going for it and buying it because this is the right time for it. Now, this is emotional trading, because based on your emotional instincts, you are trying to make decisions for your investments. This is wrong, because you don't have any particular background information, you don't have any fundamental knowledge about that script. It is because you watched it in the news yesterday, something about the same very company, and then you ended up watching a few videos in the YouTube. People might be telling you, yeah, yeah, stock of Apple is going to skyrocket, and all of a sudden you realize, okay, now I'm being left out and I'm going for this stock. So this is what emotional investment means. Now, talking about overconfidence, exactly what is overconfidence? Uh, I myself, occasionally, or you can, other words, I could say that most oftenly, I get confused between overconfidence and confidence. Because if something goes right for me, it was confidence. But if something goes bad, uh, people can start calling it overconfidence. So there's this one very thin line in between confidence and overconfidence. How to know that you have crossed that line? I think so. Practically, that is not possible while you're doing it. It is only in the past or in the history when you look behind and you look exactly where you committed which mistake. Only then can you realize that, probably this was overconfidence. But while you're doing it, I don't think so that there is any such mechanism that could identify or differentiate between at what portion of the thing comes in the place of block of confidence, and which part comes in the space of overconfidence. But if you look at the sort of dictionary or the literal meaning of the word confidence, which I'm very much sure every one of you know, but I came across one definition. which I really liked because the words were very good. Although initially I had no idea what the words were saying or what it meant. So here it goes. It says confidence is grounded in realistic self assessment, while overconfidence stems from an inflated perception of one's ability. Now, the sound of this definition is very good. I still don't get what does it mean. Because practically speaking, while you are at the stock market and you're looking at the screen and you see these numbers changing and these digits changing, it's very difficult to demarcate at which place your confidence boundary or the limit ends and the area of overconfidence starts. So, practically speaking, it's a difficult thing. I totally agree with you. But with the help of few things, we can a little bit differentiate between the two. So, overconfidence can lead to significant losses in the stock market due to several key factors. Till here, I also agree with it. It is underestimating the risk, overtrading, ignoring diversification, holding, losing positions, insufficient research, and emotional decision making. Believe me, if you go through them very patiently, you'll realize each and every point that I have displayed for you means some sense. And probably at some stages you have gone through all of these. So, as far as the definition, the written thing is concerned, it makes sense. But exactly where the problem starts of overconfidence, it starts when you say, I know what I'm doing. That is the beginning for you to realize that now you have stepped over and you have entered the area of overconfidence. So whenever you listen yourself saying, even if it's in your mind that I know what I'm doing, my advice would be just stop there, just for a moment think, am I crossing that line? I hope and I wish that you realize that yes, you are crossing that line. That is my sort of best wishes for you. That every time you think over it and you realize, yes, I'm crossing that line, and you stop and you come back. My best wishes for that thing. So now moving ahead, then these are all theoretical things. There must be something else that we are doing wrong without realizing that we are doing it wrong. So I tried to understand myself initially when I was sort of, suffering or having a lot of losses in the stock market because of my wrong decisions. Then I started sort of studying the things and started talking to people, not the people at the social media or the influencers or the educators who are always ready to give you, new training courses and guaranteeing you the success in the stock market. I'm not totally not talking about those people. I'm talking about the sort of, the teachers, the people who have gone through the process and they're ready to share their experiences with you. So when I started talking to these people, I realized that there is a lot of difference, the mistakes that we do and the professional traders, because on one end, the professional traders are always succeeding, they are always successful, making profits. On the other side, it was me standing losing every time and I was losing my capital. So here is sort of a short what I have learned through my experience. I don't say that you have to agree with it. It is upon you. Just read, go through that. Probably you might like it. Whatever portion might like, please do remember it. It might help you in the future. So the first thing is the professional trader, they understand how the system works, how the market works, because they're right sitting in the right top of the things. They exactly knows which stock is going to perform well in a stipulated time because they have huge research houses. They have lot and lots and means of information coming to them. Because mind it, I'm talking about the big corporations who have billions and billions of dollars at their disposal. They have their research centers, they have their research people, they are very well informed people. They are very much linked to the people in the policy making circle. So you know what I'm talking about. So the professional trader has the information and he knows exactly how the market work, how the system works. On the other side, it is me uh, who is trading and who is doing business, buying and selling stock as I am told, or as I get influenced from the information fed to me through social media, and I believe it to be true, and I'm doing exactly what I've been told. So that is the one difference where, the professional traders are succeeding and I'm not. The second one is the professional traders, they have realistic expectations from their stocks, from their investments. On the other side, I have very unrealistically high expectations. I want to get rich overnight. I want my investments to multiply many times in the shortest possible time. Uh, I don't know how it is possible, exactly which stock can take me to that, the very beautiful place that I'm looking for, but yet still I want to do it. The third thing that I realized that the targets that the professional traders have set for themselves, uh, they end up getting rich slowly. They are not hasty. They are not they are very patient. Uh, they are very calm. They are very, uh, you know, looking ahead, and they know exactly that the time is going to make profit out of their stocks for them, uh, because they have invested in the right stocks. They have not gone under the psychological blackmailing or the emotional pressure that comes to people like me, the retail trader, through different means that they have placed for me, the social media, the internet, other stuff. So they exactly know that their targets are realistic and they are going to achieve it very slowly and gradually. But their success is a sort of guarantee to them. For me, uh, an independent trader, a retail trader, my only aim is to make lots of money very quickly, which is not possible. Now, beside these, if you go to look at the working and how the professional traders are evolved, so they have a very systematic approach towards different things, stocks, commodities, and other stuff. Uh, the minimum time period that they have placed in front of them is between 6 to 12 months. On the other side, I am talking about day trading or swing trading, which too is at the most for at least 8 to 9 trading sessions. So I'm not looking beyond 10 days' time. That is in ideal cases for people like me, the retail trader, because most of us are stuck in the day trading thing because we don't have the capacity after spending some time at the markets to look at least a month ahead and to decide accordingly. We are restricted, rather, we are encircled by a boundary line which doesn't exceed 1 day's time period. So, this is one of the problem that we are facing. Uh, the professional traders, they have diversity in their portfolios. They calculate the risk management. They have people for them, advising them, guiding them how they should do their risk management. On the other side, if you look at the retail trader, people like me, we have sort of clustered risks. Most of our risks are based because they are aimed of recovering losses that we have made in the recent past. In order to recover those losses, we go for, as per our understanding, go for calculated risks. So we, by doing so, are expanding our risks into small clusters and small pockets. And after some time, these risks become so enormous that we lose most of our uh, money, most of our sort of the resources that we had brought to the stock market when we started with this thing. So one of the big difference is here. The other thing is that they think long term and we think short term. So definitely we have already discussed it earlier. And finally, they believe in consistent growth and in slow time period with slow value increase, whereas we totally believe in capital destruction because our pure aim, our main aim is uh, short term gains and short term investments. So that is one of the problems that most of us have. Now, if you remember in the beginning, I put up two questions to you that when you were coming to the stock market, with what perspective, like long term or short term gains perspective, in which time frame did you decide to come to the stock market? And the second question was, do you know how many times the stock market in your respective country has crashed? So, as most of my audience is here in Pakistan, so I came up with the example of Pakistan Stock Exchange. I'm going to provide the links in the description of this video for most of these stock exchanges crashes. If you can be kind enough to just go and click over there, so you will be getting the history. But the basic principle that I want to highlight, and the aim of putting that question in the first place, you will get it once you hear what I'm trying to say. So in Pakistan, over the last 25 years, we had three major crashes at the stock exchange. One was in 2005, the second one, which was in 2008, and I'm quite sure you're going to find this 2008 commonly in the entire world because that's the time where the entire global uh, financial system and the stock exchanges crashed. And the third one, and most commonly again, was just sort of in between when the COVID pandemic came in the world, and most of the stocks crashed and the stock markets got sort of affected. So coming back to Pakistan Stock Exchange, uh, in 2008, when there was this global catastrophic events were taking place in the global stock markets, so the same thing was happening right here in Pakistan as well. So on 18th of April 2008, when the Pakistan Stock Exchange was floating at almost 15,676 points, uh, as the market sort of crashed, uh, so the numbers started to collapse as well. And over a period of 3 to 4 months, the Pakistan Stock Exchange lost almost 6,000 points. And at one point, it became so fast that our sort of, the overlook watchdog in Pakistan that we call Securities and Exchange Commission of Pakistan and the administration of Karachi Stock Exchange, which is the main Pakistan Stock Exchange, they decided to freeze the Pakistan Stock Exchange. Now, for the people who are not familiar with this word freeze, uh, the word freeze, the terminology freeze means when the stock exchanges stop to function and you cannot do any business or any sort of trading in the stock exchange, like it just closes down. So on 27th of August 2008, Pakistan Stock Exchange was closed, and at that time it was at 9,144 points. Now, the interesting thing is that it remained closed for 110 consecutive days. Almost 4 months, the Pakistan Stock Exchange was closed. There was no trading, no business was carried out because of the fear that the crash was so fast and so devastating that the people right sitting at the policy places, they thought that if they're going to open the stock market, uh, most of the people are going to lose all their life savings. And finally, after 110 days, when it opened uh, on 15th of December 2008, after a few days, it again came back, and finally the downturn momentum stopped at near the levels of around 4,100 or 4,200. And from there, it slowly and gradually became to rise again, and the bounce back process for the Pakistan Stock Exchange started. Now, why I gave you these questions in the first place, and why this example became so pertinent, and the stock exchanges crashes of your country, why are they so important for you to go through? The reason, it will be just a few seconds away. So before we conclude today's video of why people lose money in the stock exchange, you have to avoid greed and fear if you want to stay for long term in the stock market. Now, why this factor of greed and fear comes to you in the first place? It is because we somehow believe that if this time the market crashes, it is not going to recover. It's never going to recover, and we are going to lose everything. So that was the reason that we asked you the question right in the beginning of this video. And just before you seeing this, we explained as to how 2008 market crash of Pakistan sort of, happened, and what happened during that time. So the second point to conclude today's video is, remember, the stock market is markets all around the world are here to stay. They are not going anywhere. So don't be afraid. Don't get greedy that you are going to being missed out or left out. You're not going to get another chance if the crash happens. So you're going to lose money. Nothing will happen. You just have to stay put. These stock markets, they have their own way of evolving and working. They'll crash, they'll recover. This is what we have seen over the last 25 years. The example that I quoted about Pakistan Stock Exchange, which was trailing at 9,000 and something, and finally started recovering from the levels of 4,200, right now, after 17 years, is almost going to touch level of 100,000. No one who was doing trading at 2008 could ever imagine that the same stock exchange, which was closed and frozen for over 110 days, is going to be touching the levels of 100,000, 10 times more for what it was back there in 2008. The same thing, I am pretty sure, is happened to each and every stock market in all of your respective countries. So leave out this fear that it's going to end and the stock market is going to finish forever. It's not. You will always get another chance tomorrow. Don't worry if you miss a rally today, if you miss an opportunity today, there's always going to be tomorrow for you. Just you have to just wait for it. Remember that you're fighting a very laid out system, very well laid out system, very effective system. You might have heard the saying that no one has successfully defeated the stock exchange for over a year. And this is very much true, because somewhere down the line, we all commit mistakes. And those mistakes, some of the times, they become so heavy that we lose everything over it. So the system, the institutions, they are going to stay here. It is us who are going to do those mistakes, and we are going to come and go. We are not here for permanent sort of time space. We are going to keep on shifting, and we are going to be replaced by other retail traders. So in order to sustain the system, you have to be very patient. The other thing that you have to strongly believe in is that there are no shortcuts in the market. There are no easy way of making money in the market. You have to work for it. You have to plan for it. You have to uh, be very careful in the decisions you make. You are going to avoid emotional decisions, because there are no shortcuts. You are going to visualize for long term objectives and to avoid short term losses, because both of them are two different things if you deal them properly. And finally, make smart decisions, avoid emotional and hasty choices. Believe me, they are going to help you in the long term. Probably you might not agree with this thing right now, but in the long term, you will see the difference. So coming back at the two questions that we have all come to the stock market from a long term perspective, but we have to understand and we have to see to our businesses that we have carried out so far, that was our activities in the stock market purely as compatible and as required by a long term presence in the stock market, and to identify the mistakes that we have done over the years. And the second question that we put to you in the beginning was that no matter how the stock market crashes or how the stocks go bad and their values and their levels fall, they are always going to strike back. They are always going to come back. Now, this brings me to a third question. Uh, Although I'm not going to display it because most of you are going to get angry with me that, I'm just going putting questions and questions. So do one thing. Just Google how many times your respective stock exchange has made a highest level and whether it has been able to break the previous highest level and achieve the new high level. And identify, or please identify, one single stock market for me where they say that it achieved the highest level back in 1960 and so far it has not been able to break that highest level. Because I did some sort of little bit research on this thing, I couldn't find a single stock market which has not broken its past previous highest levels. All the markets set achieve a new level, then breaks that level, achieve a new level, and then breaks that level. This is how the thing works. This is how the stock markets evolve. So, regardless of which country you belong to and which stock market you're working in, it is always going to break and make new levels. So don't be worried, just relax. So this brings us to the end of today's video of our special series that we normally bring on the weekends. Uh, Thanking you for giving us your time, sparing us your time in watching this video. If you have watched it completely, we are very grateful to you and hope that if even if you have sort of got 1% of what I was trying to say to you, and if you have achieved 1% out of this video, I'll be very happy and I'll think of myself as have accomplished what I was supposed to do today. So wishing you all the best of luck, very happy trading careers, and wish you all a very happy trading sessions. Keep smiling. Thank you again. Stay blessed and stay safe out there. Thank you.